This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
On Friday, September 22nd, the Norris Group proudly presented its 10th annual award-winning black tie event, I Survived Real Estate. An incredible lineup of industry experts joined Bruce Norris to discuss perplexing industry trends, head-scratching legislation, and opportunities emerging for real estate professionals. All proceeds from the event will benefit Make-A-Wish and St. Jude Children's Research Hospital. This event would not have been possible without the generous support of the following platinum partners: HousingWire, Coach Fullerton, Coldwell Banker Town & Country, PropertyRadar, the Apartment Owners Association, the San Diego Creative Real Estate Investors Association, InvestClub, Brisas Escrow, MVT Productions, Inland Empire Real Estate Investment Club, Realty 411, and White House Catering.
I think what's going to happen is we're going to move past loans and past transfers as we know them today. I think we'll see a completely new innovative product where it says, you own this home, but you own it like you own a share of a REIT. And you get, if your home, your share goes up in value, you get that value increase. But any day you feel like moving, move. And we'll put somebody else in that one. And we'll just trade shares.
Sounds like real estate Bitcoin or something.
I think it will. I think it'll be like the way to move past this is to stop thinking about the current solutions. Right, the mortgage business has been around for so long. It's time for it just to go away completely. No offense.
I like when these two get together.
Think about it. I mean, just whether it's blockchain or something else that says there's a completely whether it's blockchain or something else, like we need to think about home ownership in a completely different way, where there's a frictionless, marketplace. Because the amount of friction, right? So you think about it. If I've given, this property comes in, I've spent thousands of dollars on title insurance. Right? If it's not trading hands, really, it's staying within this thing. We don't need title insurance anymore. Sorry, title insurance companies, right? But I mean, like everything could change. And I think for those that are in title insurance, those that are in lending, those that are in real estate, it's going to be something like that disrupts everything.
I think Roofstock's trying to do that.
What? Okay, what is that?
Roofstock.
Roofstock is, so there's folks around talking about this at the fringes.
Which is?
In Silicon Valley today.
Which is, I don't know what Roofstock is.
It's kind of another model like Open Door, except more like
fractional ownership.
Fractional ownership?
Yeah.
Okay. Roofstock?
Roofstock, OfferPad, Open Door, Knock. You should be following all of those.
Okay.
Well, I can't believe you don't know Roofstock, because Roofstock's an MLS for selling homes with tenants in them. So if you want to sell a home with your tenant in it, you go to Roofstock. You want to buy a home with a tenant in it, you go to Roofstock, and all the due diligence is laid out for you.
Maybe we interviewed them. I forgot.
Yeah.
I think we actually.
I told them to sponsor here, and they had something else going on.
Oh. Yeah, I guess that's over, huh? Yeah, the guy doesn't even know us. All right.
I'll be here
I've got to ask this, and I didn't think I would be in any doubt about the answer, but now I am. Do you expect a downturn in real estate? Maybe I ask this. Do you expect the next downturn in real estate to be mild or harsh? Anybody? And why?
When?
Yeah, when, yeah.
When's a good question.
Our view is that given that there is this supply problem that exists today, and we are late cycle, there will probably within at least the next 24 to 36 months, there'll be another recession. But because of that supply shortage, housing is likely to return to its normal cyclical pattern where it will actually lead us out of the recession. The question is how far unemployment goes. If unemployment only goes to, say, 7%, what you see is some easing off on price pressure, and you see rates are certainly not going to go up. They're going to go down. And so those 93% of households that are still employed, some of them will want to...
How far will it go down? We'll get to 2 something? Like the cover of this report?
Right.
Okay. Do you have an opinion of the next downturn?
We're running out of time.
No, we're not. I've got the clock.
I'll just say I don't think we're going to cause the next downturn. We'll just be impacted by it. And we did a deep dive on 20 industry sectors that might cause it. I think healthcare is massively over-levered, and healthcare is 17% of our economy. The stock market, actually, more people are borrowing money to buy stocks today than since 1929. The tech companies getting interrupted, the retail industry is getting disrupted, but all the issues are in publicly traded companies who went out to the bond market. There's no issues really with private companies who couldn't, because the banks have been pretty conservative. So we identified what risks are out there, and I think Doug hit the nail on the head. If we go to 6-7% unemployment, we'll be through it just fine. If we go to 10, it'll be ugly, but we'll be leading this out of it because we are going to need more construction because of the demographics. So I guess I waffled a lot there, but our forecast is it won't be that bad is our best guess.
Okay. I mean, one of the reasons why I think it wouldn't be nearly as severe and maybe very mild, first of all, you will get an interest rate that's very reasonable. We have not pulled out equity this time, correct? And we've had this pretty good price increase, but it hasn't been our habit to borrow all the money out. It's still sitting there. And instead of having a variable loan, a pretty high percentage of the time, whatever that is, we haven't gotten that loan. It's fixed, and it's fixed with a 3 or a 4. So I look at that and go, okay, I don't see, you're going to lose your job and you're going to have some people lose their house. But that's not going to be a dominant percentage of what's available for sale in the next downturn, especially if we sort of kind of pre-played how we're going to handle people that can't make their payment this time. And I think we're going to treat them kindly.
Well, the smartest thing to do for everybody is to just forbear their mortgage payment until they get a job back. I mean, everybody wins in that situation. So hopefully that's what people do.
What about, and just for the sake of argument, what about the ultimate investor in their forbearance?
Well, I think they'll lose less that way. I mean, how much did they lose when we threw them out of the house?
Well, I don't know. I get to the point, and this is a great debate here. I was raised, I guess I'm older than you, that if you sign the mortgage, it's yours, and if you can't pay for it, you lose it. And it's not the government's job to step in and help you out. And so there's some accountability in there, which we didn't have. We picked winners and losers in the meltdown. We let some fail, and we bailed others out that shouldn't have been bailed out. And we've got, Doug's been in conservatorship, not personally, for 9 years now, right? And it was going to be temporary. And if we'd have left it alone and let them fail, they could have come out on their own 2 years earlier, and we wouldn't be in this mess today. So at some point, you got to let it take its course. That's just my opinion.
No, I agree with that. But, I mean, if you're going to be running a $1.7 trillion mortgage pool, you may look at it and say, okay, I want to foreclose on this guy because he's not paying his job, but that might cost me $400 billion if I do that, and maybe if I can just hold on and help the guy till he gets his mortgage back, it only costs me $100 billion. That's a big difference.
That's a lot of ifs. I get that. I'm just talking about basic black and white what is right and what is wrong. To me,
I didn't say it was the right thing to do, not to violate a contract, but I did say it was an option that I think people learned, that if I'm the holder of that mortgage, I will get more of my principal back that way. That's all I said.
And actually, SoFi, which is, to Sean's point about the innovation in the space, SoFi, one of the things they do is if they have your mortgage and you lose your job, they help you find another job, specifically because of that issue. So they actually have a job location function within the mortgage unit.
Wow. I have to think about that one.
I think to your point, though, there's a ton of unintended consequences. I sometimes joke that it started with Nordstrom, right? This idea that you can just walk in and return anything, and it's becoming pretty widespread. Kim over here, my support person, occasionally has to deal with somebody who just thinks because they say they can get whatever they want, and I think it's an interesting thing, right? Maybe, whether it's customer service or whatever, maybe we should be saying no to people who are doing the wrong things, and more yeses to the people that are doing the right things. And
Wow. I need a drink.
But I mean, really, from customer service to all this stuff, we're building in this idea that you don't need to, follow whatever's right. You don't need to make your payment. You don't need to, and there shouldn't be consequences, and we should protect you. I think there's big long-term unintended consequences of where society goes and where society devolves because of that. To kind of back up your point, I think we'd be in a very different financial position had we not let a lot of people sit in their houses and not make their payment. We still have Nevada, which has seen a big increase in price. They have 10.6. They have the highest negative equity in the nation. And they basically made foreclosing illegal, right? They changed the laws and said, robo-signing, at the end of the day, we're going to put you in jail if you robo-sign a loan. What person at the end of the day at any bank knows anything about the loan? The computer knows everything about the loan. Are we really going to make somebody sign off? Well, there's no personal bankers anymore. And so we're going to put you in jail if you robo-sign? I mean, yeah, we've gone a little off the reservation.
No, it's okay. No, it's fine. You're known for that.
Yeah, Bruce doesn't look at the watch anymore. He looks at his phone. I mean,
Yeah, high-tech Bruce, okay. Any tax law changes any of you think are going to probably be implemented, and what would their impact be on real estate?
Yeah.
No? Okay, a big...
It's the only good thing I could potentially... Well, no, never mind. It's the one piece I'm looking forward to out of this administration.
Is the tax...
Some tax relief, personally.
Okay.
Not necessarily saying, it's whatever, but...
Okay. So you think that, is that going to happen? You think that's... I'm hoping it happens too, of course.
so personal opinion that we get relief and not reform. And that's a sad thing.
Yeah. I think it'll put us in worse shape long term, and help my pocketbook short term. I think that we may, if we get anything, that's what we'll get. We won't get, something that fundamentally puts us back on track. And, this debt thing we've got is a permanent thing. It's, you talked about quantitative uneasing. Yeah.
40 trillion, yeah, that's pretty much.
Talked about quantitative uneasing. That's going to last months until the next recession, and then we're going to go back the other way.
Okay. Standard deduction, that's maybe something that goes up so high that it makes, and you already did a report on that, the interest deduction is almost a moot point for a great many owners. That would make it completely. Right. So what do you think would happen to the desire to own a home? Does that have any impact at this point, or is it already a moot point?
Well, let's separate the desire from ability. So all the surveys still say that everybody wants to own a home. So the ability would be, does it make it any easier? For some people it might, because they're deducting $24,000 now and they can save and pay less taxes. And I don't know the net answer. I haven't studied it. We did do a white paper on the mortgage interest deduction, though, and something like 80% of it goes to 5 states. And, we're one of them: New York, Virginia, Massachusetts. The rest of the country, it's really not that big of an issue except for a real small percentage of families.
It'll hurt second homes, RVs, and boats. Getting rid of the mortgage interest deduction will hurt those 3 things.
Okay.
Bad.
But if you're asking, will it happen? Our whole forecast this year has been predicated on no health care reform, no tax reform, and some regulatory reform. So, the 3 rules of forecasting: if you give a number, don't give a date. If you give a date, don't give a number.
Okay.
If you get it right, don't look surprised.
Okay. Doug, you had mentioned in our interview, we didn't have time to talk about it, that we need to get back to GDP growth of 3% or more. You thought it was possible, but didn't see policies being implemented that could be. So what?
Refer to my prior answer.
Oh, okay.
Yeah, I mean, healthcare reform is the key because it was the thing that determined how far they could go toward reform versus relief. So if you don't get healthcare reform, you're not going to get deep tax reform because of the cost, as John referenced, is the share of GDP which goes to healthcare. So that was the key. And there is still, I think the Senate is like one vote away from failing again. But so there's still a little bit of hope of that happening, but it won't have any impact on this year. If they get that, then you may see some progress on taxes. But remember, in the Reagan administration, there were the marginal tax rate cuts that were made in 1981 that took effect in 1983. That was intended as an economic stimulus. Fundamental tax reform took place in 1986. And it was possible because the real GDP growth, that is after inflation, in 1983, 84, and 85 were over 4%, over 6%, and over 4%, again, those next 3 years. So you could get all the lobbyists together around the table and say, growth has been so strong, we can actually survive a fundamental tax reform. That is not the world today.
Right. Okay. All right. We are closing in at the end of the time. So I'll have you answer, and we'll go from Doug to all the way down to my right. Are there any black swan events you're concerned about, like anything keeping you up at night, or what's the one thing that you're most excited about for 2018? Quite a difference there.
Yeah, well, we have, if North Korea sends a nuclear missile into Japan, that would be to me a black swan event. We have no idea what the world reaction to that would be. In terms of things that are exciting, this is a pure economist's answer. This is why you don't go to economist cocktail parties. But if you actually get the global central banks all to attempt to return to normal monetary policy, then you can actually hold your legislatures to their responsibility to manage fiscal issues responsibly. And we're coming close to the point where that's going to happen.
Okay. David?
I would agree with Doug. This personal is a question, right? North Korea, the world environment, how that affects money, trade, gas prices. Gas goes up 50 cents because of a hurricane. What happens if you have a war or a nuclear event? Could be catastrophic. For 2018, what I'm most hopeful for, was that the question, is the recruiting class at the University of Kentucky basketball team. And Coach Cal has the number one class coming in again, and that's where I went to school. So that's all I got tonight.
Sean?
I mean, on the black swan thing, in my presentations this year, right, it's I think to the degree that there's an economic black swan, we joke that Janet Yellen's job was now to have a shrink ray and bring everything to bear to try to stop that from happening, because I think to the degree there's so much debt, there's so much trouble right now. If you lose a hold of the thing, I think it is so bad that we just can't let it happen. So I think, John, you talked about that. I just reread your book, and you talked about it a little bit with John Malden and some of those things about, if this really comes unraveled, it really comes unraveled. So I don't think we even need to worry about that, because you can't plan for it, you can't do anything about it.
Okay.
And I think it's decades off, personally.
Okay.
And, I think the thing that, I don't know, hopeful is the right word, but I think we're going to have a pretty stable we're going to have more of this. It's like Japan for the last 30 years. You go to Tokyo, things are still going. It's more and more debt. It's not economically good, but it feels all right. We're coming out and having great dinners, and we're having fun, and I think that's going to continue. I don't think we're going to see anything like we all experienced in 2008.
Okay. Sarah?
Goodness, you guys are talking global war, and I just... what I'm most excited about is totally different. I think we look at, when you do a real estate transaction, how many times you have to actually enter the address of the home. And especially in California, we have 13 MLSs here. And so we are really trying to solve for the problem of smoothing that out for the practitioner, where they can enter it one time and we'll shoot it out and make that easier for you and all the way through the transaction, and hopefully you only have to enter the address one time and it'll kind of follow you through. So I think there's a lot of things we can do from a data standpoint to kind of make all your platforms talk to each other more effectively and efficiently for you.
Okay. Hey, a breath of fresh air. Yay!
No more economic talk.
We should have had her go last.
We should have had her go last.
So, and on a bright note, from the concern thing, I'm a little worried about the stock market and the impact that would have on the pension funds, who are now no longer unfunded pension liabilities. People are actually asking for their cash because there's a lot of retirement going on. So that scares me. I don't know how it plays out. On a more positive note, we talked about some of this disruption and big data and everything Zillow's doing. I find that exhilarating. That's changing our business. It's asking us to be smarter and quicker. I don't think 5 months is the new normal on the MLS anymore. I think it's more like 2.5, because you can sell your home in an afternoon, where it used to take you 30 days just to get the open house done. I think that's exciting, and so I'm looking forward to more of that and seeing who the winners and losers are next year.
I'll wrap up with the same thing I've said every year, probably for 10 years. I would like for the next year for every elected official to not be a Democrat, not be a Republican, but be an American.
Bruce?
Yes.
So I want to say, of all the places I get to go, this is the third time you've invited me back. Thank you. And I know that I can speak for everybody up here tonight, that you should have been born in Kentucky, because there's not a finer gentleman in the world than you, and you make everybody feel great up here. Thank you very much.
Thank you very much. Thank you. Thank you guys very much. Well, it's time to say goodnight. Thank you for participating in another great event. Thank you for the panel. It was great answers. It's so much fun preparing, and when I thought it was completely done, I made a printout of it, and anything that you see written now is changes that came from a hotel room an hour before I got into the... I have so much respect for who's here that I'm trying to get the best questions so we can get the most information. But we could have stayed here for a few more hours, but we don't have that time. So join us again next year. We will do it again. Thank you very much.
The Norris Group would like to thank the following gold partners: First Lending Solutions, Guaranteed Rate and Nathan Chaboya, In a Day Development, Inland Valley Association of Realtors, Jennifer Buys Houses, Keller Williams Corona, Keystone CPA, LA South RIA, Michael Ryan, New Western, North San Diego Real Estate Investors, Northern California Real Estate Investors Association, Orange County Investment Club, Pacific Premier Bank, Pasadena Phoebe, Pilot Limousine, Real Wealth Network, Rick and Leanne Rossiter, the San Jose Real Estate Investors Association, San Francisco Bay Real Estate Networking Summit, Sunoco South Orange County Real Estate Club, Spinnaker Loans, Think Realty, U Direct IRA Services, West and South Coast Plaza, Wilson Investment Properties Inc. See iSurvivedRealestate.com for event information.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.